So, okay, we're going to start just a few things. I'm going to start a little bit about the forum, and then I'm going to talk about a few things, a few sentences that I heard this week that I think will inspire you and could be good for your trading. And then I'm going to announce the topic and we'll go from there. So, first thing, Jake, remind me where I share the screen here, right? I just click here and share the screen, right? Okay, right. Okay, you can do that for me. Okay. All right. So we'll go first to, let's see, where we're going to go first. We want to go to the web here. Okay. So we're going to go, not this one. Where did we open the Optimus, the community side? Do we have it open? Okay. Let me see. Let's open it here. Okay, here, and go to the community. So you guys can see the community site now. Let me see. Okay. Okay. And there we go. Okay. So now you see the community site. Okay. So first of all, I want to thank all of those who participated. Thank you very much. Thank you for Colo Sean, who's took the initiative to start topics and is participates here all the time. So very nice of him. So just a few things, okay? So we started a new thread with Ben, and basically this is going to be the market profile thread. So I just announced it, right? I just created it, and we already saw questions that came from Trader, whoever calls himself Trader, and then Ben went and answered that, and then he will start, with basic things, and we'll progress to more and more advanced. So Ben, thank you for taking the initiative, to participate, and obviously taking this project of market profile that a lot of people are interested in, and day traders could benefit from it. If we go down a little bit, you can see, you can ask technical questions about the platforms that you have, and Jake will answer here. Like, for example, somebody asked here about some documentation, and Jake answered that. And again, my goal is really to have a lot of content, because again, my goal is to provide free education to everyone, and you in return provide content. So obviously Google can find us, and if Google finds us, customers find us. Really like how, the what's your future style, kind of evolved, and we've added a lot of content to it. So I suggest you go to that thread as well and read what other people say in their style, and maybe you want to adopt it, or maybe you want to ask them questions, or you just want to share your experience and give your feedback. But I really appreciate, the questions that you're asking and everything else. So definitely, I want to build a community of people who trade. I'm not going to hide it. I always wanted to build my own community, because I participate and I see other communities, but it's just a lot of hypothetical stuff that I just disagree with. And this is something that gives me a little bit of a control to add, gives me a little bit of a control, as far as applying to things, from my perspective. I will reply to some of them as time allows. I'm very busy throughout the day. Me and Jake were on the phone literally from 8 o'clock until 5 at night. We don't get a break. So I apologize that I didn't give a feedback to some people, but I will. Okay. So that's one thing that I wanted to cover. All right. So a few other things. Okay, we can, Jake, you can go back to, all right. I'm going to stop the share. Okay. So, hello, Michael, and new guy here, Lowry, I guess. If I mispronounce it, I'm sorry. All right. So, some things that I wanted to share with you as far as trading. So, and we're going to talk about, I know today was was a difficult day. I know it was, a down day. It's hard to trade in down days that are volatile, but really it was just kind of I'm not happy that if somebody lost money today, but I'm happy that today's price action will match actually the topic that I'm about, to talk about. So here's a few things. Okay, so during days like today or volatile days or anything like that, there's a lot of decisions that you guys are going to make. Okay. Now here's a new perspective for you and something to think about. Let's say you took a trade today, okay, on anything. Okay, you went long or you went short, right? Let's assume 30 days from today, you didn't know that you wouldn't remember your trade. But let's say 30 days from today, you go back to today, okay, and you can actually go to the chart and you can say, I would have taken this trade, I would have taken this trade, I would have taken this trade. If you cannot identify a trade that 30 days from now in the back, it means today's trade was not a good trade. And I don't mean a good trade from a perspective of winning or losing. I mean from a perspective of it was just spontaneous. So you just didn't follow your plan. If you didn't follow your plan 30 days from today, when you go back and look at the charts, you wouldn't be able to recognize it because you would not remember where you spontaneously placed the trade. However, if your trade was good, you go 30 days from today, you could do that. So just do that exercise. The trades that you take today, don't try to remember them. Write them down somewhere, right? And go back 30 days back, or look at 30 days back at the trades that you did 30 days ago, right? And we have you can track those trades through your statements or through your platform, or if you don't, you can ask on the forum. We'll tell you how to do that. But if you go back 30 days, you should be able to recognize the trades that you would have taken because you know your method. You know the entry, you know the conditions and everything else. If you can't identify them, ask why can't you identify them? What has that happened that you look back and you say, you know what? I recognized 2 trades out of the 5 that I took. What are the other 3 that I took? Were they spontaneous? Was there something different? Now, some of the trades, maybe they were legitimate, but at least you'll know why. You have to start recognizing yourself as a trader. So basically, I believe in this kind of going backwards and looking at what you did, and it gives you a perspective whether, there were trades that you shouldn't have taken, or maybe there's trades that you would have taken with let's say you identify a trade, right? So that means, okay, you took a trade, you weren't spontaneous, you followed your plan, but maybe you did too much size. Maybe your size was too small. So looking back at what you did 30 days before without trying to memorize it would give you an idea and saying, okay, you know what? I follow a method. So you should be able to identify them. All right. That's one thing. Another thing that I wanted to mention, and those of you who are not familiar with the format of these presentations or these webinars or anything like that, I usually go over a few things that I think are important, and then I'll jump into the main topic. This is not the main topic. It's just a lot of things that I gather throughout the week. I write it down and I say, okay, I'm going to share it with my Optimus warriors, on Thursday. So as far as information, just remember one thing. I know that nobody has endless amounts of money, but just keep in mind that even your bad trades are information gathering. Any field that requires long-term performance, anything, forget about trading for a minute, athletes, marketing, anything that requires long-term. There's a lot of mistakes that happen along the way, or coaching a team in basketball. There's a lot of things that happen now, and a lot of them are mistakes. but this is information gathering for you, right? The mistakes that you have done, gather the information about the mistakes you have done. They're valuable, right? They're very valuable. They're diamonds, and because they tell you what mistakes you have done, and you have to make sure that you don't repeat them in the future. So believe in the information gathering process from your good trades and your bad trades, right? That's what you're doing. Now, the last thing that I will tell you about some things that, as far as, things that I've heard this week that I think are really important is that when you have a signal to go long and go short, at that point you become an order taker. You don't become a trader. You're a trader up to the point where you get the signal to get in. You're an order taker when the system happens. And I'll explain, right? So a lot of people, they have a system in place. And then it tells them short. Let's assume a day like today, market was down. It's already down 1%. It tells them to short, right? And at that point, they start thinking. They're like, well, what if it reverses? What if I'm selling at the bottom of the market, and from here it's going to reverse? So all those thinking processes that start going, and doubt and everything else, and many times that will prevent you from taking trades. You have to be very conscious of it. Your goal is to be an order taker, not a thinker when the system occurs. That's it. You have to have everything predetermined prior to the trades, and you got to have your targets. You got to have your profits, your targets, your stop losses, and everything else. On this note, before we start the webinar, okay, just to remind everybody that there's a substantial risk of loss on futures trading, and past performance is not indicative of future results. We take those videos, we do publish them on YouTube as well. Thank you for joining us, Mr. Kemp. Good to see you. So those are the three things that are extremely important, to do that. Another thing that, talking about being an order taker, so again, you get the signal, you don't think, you trade. And what makes you a trader is your profession, is what you do day to day. It's not the actual act at that moment. At that moment, you get the signal, you trade. I've noticed one thing, and I'm going to publish it I'm starting to put some of my analogies on the forum. But one thing I started observing when I talk to traders and I ask them what their challenges is always the word loss, right? So they always ask, well, what if I lose, right? So they get the signal, everything is done, and then, the market is going down, down, down. They get a short signal, it tells them to sell it, which would have been today maybe the right thing, but then they ask themselves, what if I lose? Let me tell you, okay? If you can't afford to lose, don't trade. That's number one. And I mean it sincerely. If you can't afford to lose and it's hard for you, just don't trade. Honestly, there's a lot of other things to do. Trading is not one of them. But I'll tell you this, the thought of the sentence, what if I lose, is so destructive that it actually makes people do the opposite of their method. This is where a system tells them to go short. They ask, what if I lose? They go long. They do the opposite. It goes up, they should be part of the trend. They get a buy signal. They're saying, what if I lose? What if I'm buying top of the market? That's exactly when they do the opposite. The opposite of what their method told them. It's the worst sentence in the world for a trader. What if I lose? Clearly, as you approach trading, you should be, you should understand, that you can lose. But to drive yourself not psychologically on every single trade, that is destructive. Accept it that every trade you could lose. Accept it, way ahead of time. Don't think if you have a method, right? So just please keep that in mind. Okay, I hope it helps you. All right, I'll tell you what my topic is today, okay? My topic is today about being flexible as a trader, and I'm going to use two, there's probably more, but I just wanted to use two examples to give you a flexibility as far as being a trader and a method, as far as being flexible with your own method. What do I mean by that? So there are days that there could be periods that you use the same targets, right? You use the same stop loss, you use the same profit, right? And by the way, just as a legal disclaimer, because I have to and I'm licensed, when you stop losses are not guaranteed to get filled at the prices where you place them. There could be market conditions that it's just unable to execute, and obviously there's slippage involved. So, you have your targets, and most of the time, let's say you're trading, let's say the NASDAQ, and you have 20 points profit and 10 points stop, 2 to 1 or 7 points, 7 ticks and 21, 3 to 1, whatever the case is. And that works, very well for a very long time. And then there are periods that the market is just some sort of a turmoil and it's not working. So unfortunately, what many people do is that they look for a new method. They say, okay, my method doesn't work. And I say, slow down. Before you do that, slow down, because what you need to understand at that point is that your system could be good. You just might need to give it more space. So a good trader is also a flexible trader. So one of the things to examine is, do I have to give this specific market more room? So a lot of people say I like to trade 3 to 1 or 2 to 1 or 4 to 1, 5 to 1, whatever the case is, which is fine, but you can't choose random targets without knowing the context of the market. So today I'm just going to use just two, okay? I'm just going to use two indicators that could help you out substantially, okay? One of them is the VIX, okay, which is the volatility index. And the second one is a technical indicator that's called ATR, which is average true range, right? So that's basically the two, and we're going to review them. Okay, so now, Jake, help me again. I need to share my screen. Okay, and I have to go to the Word document. Yeah, the Word, here we go. Okay, and I'm gonna do share. So I'm going to, okay, so ignore this just for a minute. Just look at this, okay? And what I'm gonna do, I'm gonna copy this and I'm going to put it in, this is not the one. How do I go back to the chat here, Jake? Take me back to the chat. All right. And then we'll discuss this for a minute, okay? All right. Oh, there we go. Genius. All right. Control V. Okay. So you can copy and paste that. Let me explain to you what the VIX is. Okay. So you understand. Okay. So the VIX, okay, is basically, it's a gauge for day traders. What it measures is the volatility on the nearby options of the S&P 500. Don't get into, we're not here to discuss truly what, how it's built and every single component, but just it's safe to assume that the option market on the futures, okay, the premiums grow substantially for both the puts and the calls, and on down days, obviously, for puts. When the market explodes, so they want more safety. They demand more money for their safety, right? So the premium expands and the options too. And usually when the VIX goes in value, typically it goes when the markets go down, and there's a lot more volatility when the market goes down. So again, if the VIX is as a day trader, you are concerned with the market sentiment that day, whether it's very strong up or strong down. But more importantly is to look at the VIX and say, okay, today the market went up this much, by this much percentage, maybe I need to adopt it. Okay, maybe I need to adapt to the new environment today as we trade through that. Just to give you an idea, okay, so now if you see my screen here, okay, so if we go here, okay, let me refresh that, okay. So today the VIX was as high as 28, well, closed at 28.29. That's the cash market. You can just put VIX in Google, and you see that the volatility increased by 35.38%, right?
Y nosotros, ¿qué onda? Pues tenemos todo eso, entonces rentamos un refrigerador. Nos salió caro, 100 pesos.
Thank you. I appreciate it. So if the volatility increased by 35%, that's substantial. And if you trade it in a day like today, you have to look at it, and you definitely have to expand your profits, and you have to expand your stop losses. It's a must. So even if you use the same method, don't throw it out the window. Just think, okay, under days like this is what I need to do. And the VIX is just a measure. Now, VIX does not tell you by how much, you should expend it. This is where the ATR could potentially tell you, okay? And it also comes from experience. It really does. It comes from experience that you see on certain volatile days, the sort of space or room that you have to allow for your method to work out, okay? So VIX is definitely a very important component in that people who are option traders, it's built out of implied volatility. Again, I'm not here to encourage you to trade options, especially not naked options where you sell and collect premium, which could be a complete disaster. I'm not for those strategies at all. I'm really just looking at it as a gauge as far as what's going on in the market. So here's an interesting part. Let's go. You can see here that in February, March of this year, when we had COVID, you obviously see, how high it went here. And let me see, this is, I think they were just, let's go in a little bit of this period. Okay, this, represents, I think, around the COVID time that took place. And the market was at 66%. Those of you who traded during those days or watched the market, there were fluctuations of 10% a day on the stock indices. And this is a market. Now, this market can tell you have to expend it, or it can say, you know what, I'm not good trading in this environment. Which is also a position. Look, it's fine. If you're not feeling comfortable trading during certain volatility, it doesn't sit well with you, and you don't want to make, remember what I said, trading is a decision-making place, and it's a decision-making profession. And if there's certain times that you don't want to make decisions because it's too stressful, don't. It's fine. It's good. So as you see, the market here most of the time is like this, but there are periods that it does that, right? So VIX is important. Okay. Let's go to right now the second one, which is, it's called the average true range. Okay. This is where I want to share with you, Jake, I want to share the new share. Okay, I'm going to go back here. Okay, I'm going to share this. Okay, so average true range. Average true range measures the range of the day. So if you're trading, let's say, E-mini S&P, I always use stock indices. Let's say you trade gold, okay? And let's say the average gold on the day is $20. That's the average, right? it gives you an idea that if you put a very tight stop loss in a range like that, it's very tough. It's very tough to exist in that kind of market. So people sometimes force their opinions and say, I want to have a 3-to-1 where I put $2, and I'm going to get $6. So 3-to-1, there we go. Fine, you can do that. But in what context? What sort of market are you looking for to make this kind of context? So there's a number of ways to calculate average to range. Any one of them is valuable. I don't want to go into every single one of them, but A is the most common. Where you take the current high, right, and the current low, and that's your range on the day, right? Or you can take the current high of today versus where it closed yesterday, right? Or you can take the previous close and do the current low. Okay? If you ask, I'll post it in the forum as well, and along with those things. So essentially, you can use any one of them. I think this is the most simple one. The high, the low, some people, if you ask why they don't use this as opposed to this, that's because, you have tail ends of the market that could be misleading sometimes. But whatever you use, all of them consistently, it's still fine, right? The large numbers still, don't lie. Okay, so now you know what average true range is, and now we're going to. Okay, now I'm going to go to. Let's see, new share, and I'm going to go to this one. All right, so this is the market today. This is the market is still active, but you obviously see, the market, went quite substantially down. This is a 30-minute over 1 month, just a little bit of a larger time frame, and I'm sorry the screen is small. I'm doing it from my laptop. Below is the exponential moving average of the average true range for the last 21 days. Exponential reduces it makes it a little bit smoother as opposed to just a regular moving average, but you can use a simple moving average as well for the last 21 days, and that's the average true range, right, that we take. So here's an illustration, okay, that now it's looking back, and if you see, here, as the market reached this point, this is not support and resistance points, right? This is not used like a regular indicator. Oh, it's bottom here, it's a top here. This is not a momentum indicator. The average true range is not a momentum indicator. I'll explain it in the context of RSI, but this is not a place to look for support and resistance. But it is a place to look at, okay, where are we in the cycle? Of what range, right? So you see here, the market for the most part is going like this, and pretty much it's up and down, up and down. But as you see here, right, you see 33 points here between the high and the low as far as the range. And by the time we get to the end of the day, again, we're at 94. Right? It just tells you that during down days, the ranges, when you trade during down days, the ranges will be higher. It makes sense, again, this is I have to just legally speaking, so nobody holds it against me. This is my opinion, and this is also my observation, right? So here, the markets, every time the markets become volatile, as they go down, you would see that the ATR is going up. There is a different psychology to a buying market and a selling market. A buying market, sometimes it's like taking the stairs up, and a down market it's like taking an elevator. It's really fast, and in the down market, in my opinion, there's a lot more doubts of people trying to catch bottoms, they're trying to get out, they're trying to pick up the markets again. There's a lot more decisions, I think, that go back and forth between the participants. And not only human participants, but also algorithmic participants that also participate in the market, right? Or, besides discretionary traders, there's quantitative traders. So if you are in this market and you see, now you can have your own charts, right? You can do, you can do your own charts, and you can decide whether you want to look at 15 minutes or anything else. I put here, a moving average of 50, but it just shows you, and again, it's not a buying or selling signal, but it shows you when the market moves way, way, way below the long-term moving averages, how the volatility starts increasing. Why is it important for you? It's important because this is the time, if you trade it today, okay, versus trading here, okay, your ranges are different. Okay, so you can have, so the good thing is the bad thing is it's higher risk. The good thing, it's higher reward. And you need to learn to adapt to that. Now, here's another thing. This is also time to maybe change quantities. If it's starting to mess with your mind, let's say you trade under, this normal conditions as the market goes up here, 1 micro NASDAQ. Just saying, as an example, okay? Or maybe you're trading 2 micro NASDAQ. Okay, well, maybe here, when the volatility is so high right now, and it reached those highs here, maybe we'll have the volatility, the ATR will start going down. You could potentially put more markets. Maybe in environments like this, when the ATR is way higher, you use less contracts. Maybe you minimize to the point that it just doesn't mess up with your mind. So the ATR is an extremely important indicator. It is not a predictive indicator. It does not tell you where the market is going, but it definitely gives you a sense of, okay, I'm going through high volatility. I'm going through a period right now that the market is very volatile, and you feel it. I mean, you feel it, right? You feel it. Like sometimes people will go with 3 times a day with the same risk reward that they've used before, and the market is so volatile and they're getting knocked out and knocked out and knocked out. And the worst thing that they do is this: at some point, they go even with a higher quantity to try and recover under the same market conditions with the same risk management as far as stop loss on the target. And again, they're getting knocked out. So again, you have to, the big picture is this, okay? You have to recognize environments that you maybe have to reduce your positions, not trade your positions, or trade the same positions but give it bigger room. That's extremely important. And again, I'm not an indicator guy per se. I'm not looking at things, as indicators as a looking to, oh, it's like this here, then I have to do this. I'm just looking for a bigger picture. Below, I put the Rsi Index. Okay, this is a momentum indicator. It's a lagging momentum indicator. So basically, it just tells you the strength, the strength of the trend. So you have here above and you have below, and on hindsight, they all work, right? Interpreting them while in the market is difficult. But this is a momentum indicator. I just pulled out the most famous momentum indicator, relative strength index, because I wanted to point out, that momentum indicators like RSI will show you the strength of the trend, right? So here, despite its volatility, so you have the RSI that keeps on climbing here, it's climbing, and you see the market is climbing, and here maybe it's losing some momentum, and it goes down and it's losing momentum. So those are momentum things. The average true range is not a momentum thing. It tells you the market is, you're trading this much, or you're trading this much, or you're trading this much, right? The range. So it's very important to do that, and to understand that. And that will give you the ability to adjust your positions accordingly, or like I said, just avoid that day, or go into trade with a small quantity to see how you can weather it. You have to learn to trade under all conditions, but it does not mean that you have to trade every single opportunity and every single day. You don't want to miss the opportunities, but at the same time, get familiar with what you're not feeling comfortable with, right? I don't care about days like this. What I mean, I don't care, I mean, they don't scare me. Because I know you just have to expand things, and you do. I've seen it 1,000 times. I don't care if it's going up or it's going down, but I definitely know the difference between physically, gravity of something, that going up slowly, and when it falls really fast. And people panic. Listen, people panic. This is why you have days down days, you never know how they're going to end. When people panic, you don't know the level of their panic and where they panic. This is why a regular day out of nowhere, like 1987. Okay, I was a kid at the time. I didn't trade. I'm not that old. But I've read about those days. I read about 1987, and all of a sudden, people, there were all kinds of stories, but people who traded at the time, and I asked them, why did it happen? Was there something fundamentally? No. Was there something different? No. No? Right? Or even if you think about, the all kinds of collapses that have happened during certain days, there's not always an explanation. And the reason there isn't always an explanation because you don't know to what degree people panic. Maybe it falls down for 2% and they're okay with it, 3%. But sometimes maybe there's a big majority of people, there's something looming in the news, and they're not comfortable, and all of a sudden they sell and it turns into a 10% and 11% and 12%. There's all kinds of environments out there, that you have to become to say, okay, I'm out, or I'm minimizing my size, or I'm waiting, which is fine. Do things that work with your nature. Don't try to imitate anyone. Do things that you feel comfortable. Like I said, trading is a lonely sport, and it should be lonely. Take less. What I'm trying to do is just give you a foundation to make decisions, not to follow what I do. This is what I'm really trying to do. Okay, that's it for today. Anyway, we're going to have a new thread. Jake, you want to publish the thread? Okay. So I'm going to give you a chance to ask me questions right now, or comments, or anything like that. And I'm just going to, okay, so I'm going to stop sharing the screen, and I'm going to go here. Okay, Jake just opened. Please go here. Okay, and please participate. I give you, again, I know that we still have to send you the books that we promised, and everything else, and we figure everything out. But basically, this is what I want you to answer. I want you to answer this question: how do you adjust your targets and stops when you trade? If you don't until today, that's fine. To share with us what you did. I want to hear from you. The more you write, the more all of you write on this forum, the more ideas I get where to help people. You might write a sentence that I could create a completely different topic about. And this is what I try to do every single day when I talk to people, and try to do that. So please take your time. Like I said, I'm going to give you the DX feed. I'm going to give you the 3 months of Optimus flow. And more than anything, when you write stuff, you're helping yourself, to understand your thought process. You'll be surprised, okay? When you write the stuff on this forum, when you'll come back in the months and the years ahead and realize how you were thinking, and realize where you were then and where you are now, and how you were thinking and how you improved and evolved. So, we're all in this together. Trading is hard. It's not an easy profession to be in, but I love the challenge. I love like I said, I don't like the markets. I really, truly don't like the markets. I know you're going to keep on hearing me saying that because I think the market, with everything that was created around it, again, it's a little bit of it's a circus, right? It's subscription letters and people who try magic indicators and people who promise you that you can imitate their method. And sometimes it causes a lot of pain to young people who don't know. Now they're just sitting on their phone, losing their life savings or whatever they have, because they think they can do this over this and make intelligent decisions, right? And some of them post big wins, but trust me, it's only temporary until the market doesn't like arrogance. So write down your stuff, or even start your own journey, meaning that write down, be accountable. You can start a position, say, okay, I'm going to write every day in my journal what I did and everything else. And again, I hope the community and myself, when I have time, I'll be able to comment. Okay. So, any questions?
Matt, I have a question. If that's, I don't know if you can hear me. Actually,
I can hear you.
Oh, perfect, awesome. Yeah, I had a really quick question, and once again, it's a really rookie question, so I apologize ahead of time for all the senior guys that are on the Zoom call. So I know the ES Mini future, and this is something that's going to be brand new for me. Is going to be expiring in March. You're talking about volatility. I've read somewhere online that trading in the month of the expiration date is generally very volatile, and you should only really be very experienced when trading it. I was just wondering if you could comment on that or provide more clarity.
Sure. So first of all, never be shy to ask rookie questions because trust me, the hardest thing to keep in mind is basics. One thing that you will learn about this business is that there's no such thing as intelligent mistakes, right? So even professionals who've been doing this for a very long time, emotions get to them. Sometimes stuff that should be basic, people are like, really? But so basic is always good. Always trade the markets that are liquid. Do not trade markets that are not liquid, right? You see the volume is moving to the next month, move to the next month. End of story, period. That's it. Don't sit there until the last minute of the. I've seen people go in, and in some positions and they keep on trading the month, and I don't know why. Go to where the liquidity is, where the volume and the open interest. When the March contract starts dwindling down, and if it's June, it's starting to pick up. That's exactly what you should do. Don't listen to anyone. That's exactly where the liquidity is, because if you're starting to trade in a market that's not liquid, anything can happen to that market. Anything. Now, stock indices cannot mathematically, I believe that mathematically they can't go negative. But look at what happened to the crude oil when people traded the month of the delivery. They traded the last month of the delivery. They said they bought near zero, thinking this could never go to zero, right? And this was also, so the next month, I believe it's the March month that went into negative, but the April didn't and the May didn't. So definitely stay where the liquidity is at, right? People sometimes trade in markets that are not liquid. Like, you have to be careful with markets, for example, that have very, very low volume. Be extremely careful. Like some people say, I want to trade, for example, the Mexican peso. You see the opportunity. Well, if one day the Mexican president says something that, that they remove something about their fiscal policy, for example, we had situations where the Mexican peso jumped 25%. I don't remember if it was jumped up or it crashed down, but it was up. If you were short in that market, I mean, listen, that's an entire account. And again, this is all as a result of liquidity. You cannot, what you want to analyze is, think of it this way. You want to analyze large data, big numbers. As the market starts dwindling and there's less participants, you have less data to work with and it becomes more erratic. And one big order could send it in a different way. So again, I hope it answers your question. Stay with the liquid markets. There's always volume. number attached every day that the CME publishes on the site, or you can look at it at Optimus Flow, and you can look at the volume, and it will tell you where to be.
Awesome. Thank you, Matt. Yeah, no, that really helps.
Of course, anytime, of course. All right, Jake, anything you want to point out on the chat that I should answer? Okay. No, I'm not going to answer that question. That's sometimes people want shortcuts. Give me a method, tell me how you trade it, tell me where the loss is. That's it, right? Everybody wants to have. Let me tell you this, okay? It makes me laugh today because it's this, okay? If somebody promises you a path to success in anything in life without pain, walk away, right? If somebody sells you pain, buy lots of pain, right? That's the best, right? If somebody says, where do you enter? Where do you exit? Tell me the exact method. And I tell them, I can't move this to you, I can't move the tears. I can't move the pain. I can't move the experience from here to you in some sort of a binary fashion with a pipe. I can't. I'm sorry. All right. Any other question? All right. Okay. Right. That's it. Okay. Okay. Those are okay. If I get data, okay, so Reza, you have a question. If I get data from another feed, if I just want to operate with your broker, can I execute trades without seeing the charts? Look, if you want to use Optimus Flow and you have another charting service that you use with another broker or you pay them, you can use Optimus Flow just for execution. It's absolutely fine. We can actually enable things on it that don't require data, execution only. Ideally, you want to have data and everything else if you use it just as your primary, but if you just want to use it for execution, that would be, very good. That's a good question. Okay, so quick question from Venus. Can ATR level can be translated to a stop loss level? The answer is yes, but the caveat to that it will take you quite a while to understand it will take you time to understand the relations between ATR to the method that you're developing. So over time, you will adjust your stop losses and your targets based on the ATR. Can you translate it, just from, just basically looking at the indicator and using it as a stop loss that day? No. But what you will observe over time is that you'll say, okay, when the market gets to this ATR, for example, and again, don't forget, ATR has a period, okay? So ATR could be a week. ATR could be, I used an ATR in the chart of 21 days. That's the ATR that I used, 3 weeks. You might use an ATR of 2 weeks. You might use an ATR of 30 days. So basically, that will give you an idea of how your system works under different ATR levels, under high ATRs and low ATRs. So yes, the whole entire, just to you, Venus, just to give you a little bit of a, kind of a synopsis here. The whole idea here of me discussing this ATR is to tell you, yes, you have to adjust your method to the ATR and see what you want to trade with it or not, right? Now, let me tell you this. Some people don't use ATR, which is fine. I just like to look at something. I don't like to guess, but not everybody uses ATR. Sometimes some people have been trading for a very long time, and they're just saying, you know what, listen, this market is just too volatile. They feel it in the first, hour of the day or 2 hours of the day. Maybe they just feel, okay, this is not the normal environment that I'm trading in, but that comes over time. Me, myself, I don't like to make those guesses. I still like to look at something as a reference because I hate my intuition. My intuition sucks. It sucks. I've learned that in my life, I can rely on my intuition when it comes to business. when I shake hands with people, people I come across just as acquaintances, business deals, just the way people talk. When it comes to the markets, my intuition sucks. So I always have to use some sort of a reference system, right? And when I say my intuition sucks, don't get me wrong, it's still a lot better than many other people out there, but it's not something that I trust enough to, to give me the right direction. So obviously continue using the ATR and observe it and see how it works every day with your system. A lot of it is gaining the experience of actually looking at it and looking at the market, looking at it and looking at the market. And obviously, listen, do your own homework about ATR, average true range. A lot of people do that. Just make sure that you learn from somebody who actually didn't just post a video, on YouTube to collect his 30 cents from advertising, but essentially knows what he's talking about. And I hope you'll have the intuition to do that. Okay, so Evan, talk to the trader that just trades the market, buying or selling based on the flow of the real data. Okay, fine. So if you don't want to use the ATR, Evan, it's fine. You can see the speed and the velocity of the direction of the graph, how fast it goes up or down. Look at the dome. Look at the prices as the price moves on the dome, because it can move like this or it can move like this slowly, right? That's also a gauge for speed and execution. When the market does this all day on the dome, up and down, despite its direction, because it doesn't fall like this, right? It would fall like this. High and low, high and low, high and low. You can see that on the dome. So again, ATR is one measure, dome is another measure. Your quotes, your quote board. If the quote board keeps on flashing numbers all the time at you, right? Then you see that you obviously see the graph too, because all people look at graphs. But that's also a gauge, right? That's also a gauge for what's going on. It's also a gauge as to what's going on throughout the day. I hope it answers your question. Okay. All right. Any more questions? I'll give you a chance to ask me. Okay. All right, guys. It's almost an hour. Again, thank you for your time. Thank you to everybody who came. And again, the one thing I would ask you all to participate in the forum, create, content, do as much as you can. And listen, thank you for coming. You guys are all thanking me, but I also thank you. And when you write the stuff, just to give you an idea, when you write the stuff on the forum, I read it, and it humbles me a little bit. It humbles me what sort of challenges we're facing. And what I try to do is basically do as best as I can to address those challenges with you, right? I see it, and I as critical as I am sometimes, and the challenges that the market, don't think for a minute that I forget what it was like for me and my enthusiasm when I came to the market as a young, as somebody who was young trader, young in the industry. I had this certain level of enthusiasm. It just took me a little bit of time, thanks to good people who kind of, taught me the core of things. So sometimes when I look at things, it, reminds me, like somebody wrote on the forum, I can share because it's public, but they're 63, they worked physical labor all their life, right? And they're just slowing down and they're saying, I want to make additional income. I want to make extra income as a trader, right? And it's hard for me to sometimes read this. It's hard because, first of all, to be at 63 and do physical labor is extremely tough. And at the same time, I don't want to be a dream killer to say, listen, but trading is not an extra income profession. It is not. It's a profession. Now, you can do it part-time. I tell people all the time, you can work and you can have a few hours throughout the day, and those are your professional hours for trading, and you're still a trader. A trader does not mean that you quit everything else in your life and you just do it. I surely won't. I like, running a company. I like having income from company, but I also like income from other things, and I totally understand others. But when somebody says I want extra income, this is what the industry sells trading ads. We'll teach you a course, you'll do this, you'll generate, okay, you have X amount of money, but you don't have enough for mortgage, we'll teach you, and now you'll be able to carry, 5 mortgages, which is not the case. Trading is not an extra income profession. It's a profession, and you have to go through a lot of education. You have to go through a lot of pain. Now, pain does not mean necessarily losing always a lot of money. The goal is not to lose money, right? The goal is not to lose a lot of money. You can lose a lot of money, but the goal is not to, if you develop good risk management skills, right? So you gather data, you make small mistakes, and you trade micros, if you're a beginner. But if you approach this profession from a mentality of it's extra income, then you think the market owes you. Then you think there's consistency every day, and there isn't. What there is every day is a challenge. And the consistency, as far as returns, is an average of months and years that turn into numbers. But it's not every day. So your goal every day is to execute. Your goal every day is to be disciplined. Don't think about the money part. Your goal every day is not to make money. Your money, and I'm going to say it 1,000 times, and if somebody gets bored out of it, it's fine, but I'm still going to do it. Money in trading is a byproduct. Just remember that money is a byproduct. Money is a byproduct of any success. So money in trading is a byproduct of your risk management, of not getting emotional, not trading too much, like trading the right size for your account, reviewing your account daily, making sure that you understand the mistakes that you have done. You're not, sometimes you have to be hard on yourself. And at the same time, when you make good decisions, you have to pat yourself on the shoulder and say, you know what, I made a good decision. You turn that into the experience of, you know what, I made a good decision. I want to keep on repeating those good decisions, right? That's what you want to do. And so again, when I read all this stuff, my goal is to come back to those people and just not to kill their dreams, but really out of obligation to tell them, listen, I know this is what the industry sells, right? But here's the reality of trading, and it's difficult. Let us help each other build the tools and build the right foundation so we can be better traders and investors. And I want to tell you this, right? Trading taught me in life about a lot of things, right? Trading not only teach me about trading, it taught me about decision making, not to be spontaneous, right? Sometimes we're spontaneous in our life as far as the decision making. Sometimes we see things, we have certain chemicals, we act on them. I've learned to slow down, I've learned to kind of have a bigger picture and ask myself, what am I missing? What am I missing, right? So if it wasn't a great day, what did I miss? And that question of what am I missing, in all of this, when I understand something, helps me start putting the puzzles together. And then the new day begins. Okay, guys, I'm very, very grateful that you came. Thank you for the people who are joining us from different regions of the world, different climates of the world where it's cold, and taking time after work and listening. And again, look, if anything you want, you see my attitude. I'm a straightforward guy. I don't try to make anything pretty. If you have questions, post them on the forum. You can put my handle, which is mod-medz, and I'll answer all your questions. All right, guys, thank you again. All the best, and we'll see you on the next one next week. Okay.